Okay, so picture this. It's Tuesday, February 3rd, 2026. You're watching the markets, the bell rings, day's done, everything feels, well, relatively normal.
Right.
And then just out of nowhere, it feels like one of the absolute titans of the financial world just walks straight off a cliff.
It wasn't just a stumble either. We were talking about PayPal. And in extended trading, the floor just, it completely fell out. The stock plummeted over 20%.
The numbers are honestly jarring to even look at. It went from trading around, what, $52 a share
Mm-hmm.
down to about $41, $42, just in the blink of an eye. For a company this big, that is a massive destruction of value. It's not like a small startup having a bad day.
It is massive. And you have to think, if you look at the sheer volume they process,
Mhm.
something like $1.8 trillion last year, a drop that big signals that the market thinks something is fundamentally broken.
Yeah.
It's not just a bad quarter. It feels like, a real narrative shift.
Exactly. And that is our mission for this deep dive. We are going to unpack the Q4 2025 earnings report, the transcript from the conference call, which was incredibly tense, by the way,
Oh, boy.
and the slide decks. We need to figure out exactly why this fintech giant is stalling out. And maybe more importantly, what is the deal with the sudden leadership earthquake that happened at the exact same time?
Earthquake is definitely the right word. Usually just missing your earnings is enough drama for one afternoon.
Right.
But PayPal, they decided to pair the bad financial news with a bombshell announcement. Alex Chriss is out as CEO.
Immediate departure. That's the part that really stuck out to me. Usually there's a transition period or a retirement
Okay,
short.
graceful exit, yeah.
Right. He stays on as an advisor. This was just
It's effective immediately. And the board has already appointed his replacement, Enrique Lores. He was the board chair. And for those who follow the broader tech space, you'll know him as a longtime executive over at HP.
right.
He takes over officially on March 1st.
So you have this kind of awkward interim period where Jamie, who led the earnings call, is stepping in. But let's dig into the why here. Corporate boards are usually masters of the polite euphemism,
Oh, yeah.
pursuing other opportunities, strategic differences, that kind of thing. But reading this transcript, the language was surprisingly blunt.
It was brutal. The word that just kept coming up over and over again was execution.
Execution.
Specifically, the board and the interim leadership admitted that, and this is a quote, execution has not been what it needs to be. They openly said they haven't moved fast enough.
That is so rare. Usually you hear about headwinds or macroeconomic pressure or, geopolitical
I don't
tension.
think excuse, really.
But they're basically just saying, we were too slow, we messed up.
Precisely. And that gives us a huge clue as to why they chose Enrique Lores.
Hmm.
When you think about HP, you don't necessarily think about wild new fintech trends.
Yeah.
You think about logistics, supply chains, hardware unsexy, disciplined operations. The messaging here isn't about a new grand vision. They explicitly call this an execution intervention.
An execution intervention. That sounds like something you do when the patient is in critical condition.
Well, in a way, the operations are. The mandate for the new CEO is relentless, disciplined execution. They don't need a dreamer right now.
They need a mechanic.
They need a mechanic. Someone who can actually get the gears turning again without stripping all the screws.
Okay, so the captain is changing because the ship is moving too slow.
Mm-hmm.
But let's talk about the engine. Because the core of PayPal, the thing we all know them for, the thing that pays the bills, is that little yellow button, the branded checkout.
Mm-hmm.
And reading this report, it seems like that engine is just sputtering.
This is the single most important metric to watch. If you want to understand why that stock dropped 20%, you look at online branded checkout volume. In Q3, it grew 5%.
Yeah.
Not amazing, but, respectable.
Okay.
In Q4, it grew 1% on a currency-neutral basis.
1% growth. For a tech giant in a digital economy, that is basically stalling out. That's stagnation.
It's actually worse than stagnation when you think about it. If e-commerce in general is growing at, say, 8 or 10%, and you're growing at 1%, you are technically shrinking.
You're losing market share.
Every single day.
Wow. That really puts it in perspective.
And remember, this is their bread and butter. This is the high-margin business. When people click the PayPal button, PayPal makes way more money than when they just process payments on the back end for someone else.
So when the button slows down, the whole profit engine just chokes.
Exactly.
So let's play detective here. Why is the button dying?
The interim leadership laid out 3 specific headwinds. And I think these are fascinating because they tell us a lot about the wider world, not just about PayPal.
They really do. It's a microcosm of the global economy. The first headwind they called out was U.S. retail weakness, but they used a very specific term, the K-shaped economy. We hear that term thrown around a lot. In this context, it basically means the rich are doing fine and everyone else is struggling, right?
That's it. The top of the K goes up, the bottom goes down. PayPal's user base, it skews heavily toward lower and middle-income consumers. These aren't the people buying luxury handbags every week.
Right. They're buying clothes, electronics, everyday stuff.
Exactly. And those are the people who are pulling back on spending. So if you're, say, American Express, you might be fine because your wealthy customers are still traveling.
But PayPal feels it.
PayPal feels it when the average person decides not to buy that new TV. They said discretionary spend is drying up. And then you add the second headwind, international issues, specifically Germany.
Germany. Why Germany? Is it just their economy?
It's a mix. I mean, Germany is one of their largest markets outside the U.S. And yeah, the German economy has been soft, even recessionary in places. But it's not just that. PayPal admitted to market softness and losing dominance.
What competition?
That implies competitors.
Mm-hmm.
In Europe, you have all these local payment methods, bank transfers, and things like Apple Pay are gaining huge ground. PayPal is losing its grip on the German wallet.
Okay, and the third headwind, they mentioned something about verticals.
Vertical deceleration. This is interesting. For the last couple of years, PayPal was riding high on these very specific sectors: travel, ticketing, crypto, and gaming.
The fun stuff.
Right, the fun stuff. And in Q4, the fun kind of stopped. Those sectors all cooled off and cooled off significantly. So the tide went out in the specific pools where PayPal was swimming.
But, and this is where it gets really interesting to me, it wasn't just the economy, was it? You can blame the economy all day, but they actually admitted to a self-inflicted wound. They messed up their own product rollout.
This brings us right back to that word, execution. They built a new, better checkout experience. It's cleaner, faster, supposedly converts better.
Sounds great.
But they hit a wall actually getting it installed on merchant websites.
That seems crazy to me. It's software. Can't you just push an update, like when my phone updates overnight?
You'd think so, but in the enterprise world, absolutely not. I mean, think about a massive retailer. Their checkout page is this fragile, custom-built ecosystem. It's connected to inventory, loyalty programs, fraud detection.
You can't just mess with it.
You can't just auto-update the code. It needs testing, integration, security reviews. So PayPal shows up and says, here's our new button code. And the merchant says, great, we're busy, come back in 6 months.
Or, we need your engineers to come help us install it.
Exactly. PayPal admitted they need hands-on integration support. They basically built a better mousetrap. But the merchants were too busy, or it was too complicated to install. They just underestimated the friction of the real world.
And because they couldn't get it deployed fast enough, they missed out on those conversion improvements during the holiday season.
Which hurts. That is just leaving money on the table during the busiest time of the year.
Okay, so the stock tanked, the CEO is out, the core button is stalling. If you just read the headlines, you'd think the whole company is on fire. But digging into the report, it's not all bad news, is it?
No, and that's the nuance that gets totally lost in a 20% drop. If you look under the hood, there are some very bright spots that suggest the company isn't dying, it's just pivoting. And the biggest one is Venmo.
Venmo seems like it's finally growing up. For years, the narrative on Venmo was, great app, everyone uses it, but it makes zero money.
It is finally graduating. It used to be just for splitting pizza bills, right? A peer-to-peer app.
Yeah.
But now it's a legitimate commerce platform. Revenue grew about 20% in 2025 to $1.7 billion.
$1.7 billion, that is serious money. That's not a side project anymore.
And the engagement is just huge. They passed 100 million total active accounts. But the key is that they're finally monetizing it with the Venmo credit card, the Pay with Venmo button online. They're turning that massive user base into actual profit.
And then there's the unbranded side, right? The sort of plumbing of internet payments.
The enterprise or PSP business.
Yeah.
Yeah, think of it as the white label service. When you buy something online and just type in your credit card info directly, a lot of the time PayPal is actually processing that on the back end. You just don't see their logo.
Got it.
That part of the business is turning around. It returned to double-digit volume growth in Q4. But critically, the profitability improved. For a long time, investors hated this part of the business because the margins were so low.
And now?
They doubled their net processing yield, so they're processing more volume and making more profit on every single dollar processed. That's a good combination.
I also saw a stat that surprised me about the debit card. In a world where everything is going digital, why are we talking about a piece of plastic?
because of behavior modification.
Hmm.
The PayPal debit card usage in the U.S. grew 50%.
50. 50.
50%,
Mm-hmm.
which is massive. And here's why it matters. When PayPal physically enters your wallet, the actual plastic card in your pocket, your engagement with the entire ecosystem just spikes.
It becomes top of mind.
Exactly. You start using the balance in your account for coffee, for gas. It transforms PayPal from just a checkout button into something more like a bank account.
So while the online button is struggling, the offline presence and the whole financial super app side is actually surging.
Exactly. It's a really mixed bag, which is why this situation is so complex.
Okay, let's get back to the problem child, though. The button. They can't just abandon it. The interim leadership laid out a very specific plan to fix it. They used 3 keywords: experience, presentment, and selection. Let's break these down. First up, experience.
This goes right back to that execution failure we talked about. Jamie, the interim CEO, explained they had a deployment bundling problem. They were rolling out the new visual design for the checkout, making it look pretty,
Right.
but they weren't bundling it with the biometrics.
By biometrics, you mean like Face ID or fingerprint scanning?
Exactly. Passkeys. The ability to log in with your thumb instead of typing a password.
So they updated the look, but they still made people type in passwords.
In a lot of cases, yeah.
Oh, yeah.
And that was a huge strategic mistake. They have hard data showing that biometrics drive a 2 to 5 point improvement in conversion.
Which is huge in e-commerce.
It's massive. If you make someone remember a password, they abandon the cart. If they just scan their face, they buy. So the fix for experience is simple. Stop doing it piecemeal. Deploy the design and the biometrics as a single package. Make it passwordless by default.
Makes total sense. Okay, second word. Presentment. This sounds a little like marketing jargon. What does presentment actually mean here?
This is all about the battle for the upstream.
Yeah.
Historically, PayPal just sits on the checkout page. You fill your cart, click checkout, and then you choose PayPal.
Right.
Presentment means showing the PayPal messaging before you even get to the checkout.
Like on the product page itself, before I've even added it to my cart.
Exactly. Imagine you're looking at a $1,000 TV. Right there next to the price tag, you see a little button that says, pay $50 a month with PayPal.
Ah, so the financing offer hooks me before the big price scares me away.
Correct. Or just seeing the PayPal logo early gives you confidence. And the data they shared is really compelling. When PayPal is positioned upstream, or if it's the top button above competitors like Apple Pay, the selection rate literally doubles.
So it's all about being seen before the customer has already made up their mind on how to pay. It's a battle for screen real estate.
And that's a tough battle because the merchants control that real estate.
Okay, third word. Selection. This sounds like rewards.
It is. They're launching PayPal Plus, a rewards program rolling out in Europe and the US in 2026. The idea is to create a flywheel. If you know you're going to get points or cash back, you stop thinking about which card to use.
You just instinctively click PayPal.
You just click PayPal. They want to make it the obvious choice, to quote the call. It's the same reason you use a specific airline credit card. You want the miles. They want that same loyalty loop.
Now, I want to pivot to something that sounded a little more futuristic. Amidst all this talk of margins and buttons, they started talking about agentic commerce. I had to pause the transcript and look this up. What on earth is that?
This is PayPal trying to skate to where the puck is going, not where it is. Agentic commerce is the idea that in the near future, you won't be the one navigating a website and clicking buttons. An AI agent will do the shopping for you.
So I just tell my AI, hey, buy me a new pair of running shoes, size 10, under 150 bucks, and it just goes and does it.
Exactly. It searches the web, compares prices, selects a pair, buys them. But here's the billion-dollar question. How does the AI pay for it?
Does the AI have a wallet?
That is what PayPal wants to be. They want to be the default wallet for the AIs.
That is wild. It sounds like science fiction, but they were talking about it like it's happening right now.
Well, it is. They're already making moves. They're live with Perplexity, the AI search engine for purchasing. They're live on Microsoft Copilot. And they just announced an agreement to acquire a company called Symbio to bring this tech in-house.
Okay, tell me about Symbio. Why them?
So AI agents are smart, but they struggle with messy websites. They need structured data. They need a catalog that's easy for a machine to read. Symbio specializes in connecting brands to retail platforms with that kind of structured data.
So PayPal is basically building a universal catalog that these AI agents can plug into and buy from.
That's the goal. When the robots take over shopping, they use PayPal rails to move the money. It won't move the needle on revenue in 2026. It's way too early for that. But strategically, it's their insurance policy against the web browser becoming obsolete.
That's a smart hedge. If people stop visiting websites, the PayPal button dies.
So they need to be embedded in the AI that replaces the website. They don't want to miss this platform shift.
But let's bring it back to the cold, hard cash of today. Because while AI shopping is cool, investors were spooked not just by the past, but by the guidance for the future. What happened there?
This was the biggest red flag for Wall Street, and probably what caused most of the panic selling. They withdrew their long-term guidance.
Ooh.
At their last investor day, PayPal gave an outlook for 2027. In this call, they officially said, we are no longer committing to that.
That is the corporate equivalent of saying, tear up the map, we have no idea where we'll be in 2 years.
It creates massive uncertainty, and markets hate uncertainty. When you remove the goalposts, investors just assume the worst.
And for 2026, the immediate future, the guidance was pretty tepid, wasn't it?
It was. They expect transaction margin dollars to be, and I quote, roughly flat to slightly down.
Ouch, why down?
Because they have to spend money to fix the problems we just talked about.
Yeah.
They explicitly said that investments in branded checkouts on marketing, support, rewards will cause a roughly 3-point headwind.
So profits are going to be flat because they're reinvesting everything to save the ship.
Yes. Earnings per share, EPS, expected to be flat to slightly down. They're sacrificing short-term profit for long-term survival. It's the right move operationally, but investors hate hearing no growth this year.
But, and this is the bone they threw to investors, they're still a cash machine.
They are. And this is important. They expect at least $6 billion in free cash flow next year. And they plan to use $6 billion for share repurchases.
So they're buying back their own stock while the price is in the tank.
Aggressively. Which signals they believe the market reaction is overblown. They're putting their money where their mouth is, basically saying, if you guys want to sell the stock at $41, we will happily buy it from you.
So let's wrap this up. It's a really conflicting picture. On one hand, you have a company with these massive assets. Venmo is a giant. Their data is incredible. The enterprise business is solid. But they are stumbling on the one thing everyone knows them for, the button. They're fighting a tough economy, and they're fighting nimble competitors.
That's the summary. It's a classic case of the incumbent's dilemma. They're trying to change the tires on the car while it's driving 100 miles an hour.
And for you listening, why does this all matter? Because PayPal is a bellwether. If PayPal is struggling because the middle class is pulling back, that tells us something worrying about the consumer economy.
Sure.
And if they're struggling to upgrade their tech, it shows just how hard it is to stay relevant when technology moves this fast.
It's also a lesson in focus. They tried to do everything for everyone, and it slowed them down. Now they're narrowing their focus to speed up their results.
So here's the provocative thought to leave you with. We have a new CEO coming in from HP, a hardware guy, to fix a consumer fintech problem. The strategy is set. Fix the button, move upstream, and get ready for AI.
But the clock is absolutely ticking.
Exactly. The market has lost its patience. Can PayPal bridge the gap to the modern checkout experience before competitors steal those upstream spots? Or has the ubiquitous PayPal button, that yellow rectangle we've all clicked for 20 years, has it officially peaked?
I think 2026 is the make or break year. If they don't fix execution this year, there might not be a comeback.
We'll be watching closely on March 1st when Enrique takes the helm. Thanks for diving in with us. Until next time.